Hey everybody, Roxanne Govari, Pemberley Realty here. I am super excited to bring one of our amazing agents who does a great job for his clients, and he is a seasoned investor himself. And he also enjoys working with investors and helping them maximize their profits and helping them locate the right property. I have Andy Eakes here. Welcome, Andy.
Thank you, Roxanne. I'm glad to be here.
Nice to have you. So we were talking about working with investors. So why don't you give us some background in terms of your own experience and being an investor yourself and putting a few rental properties under your belt.
Yeah, so got my start in real estate investing about 4 years ago. I'm what many consider to be a buy and hold investor. I do both long term and short term. And how many units do I have now? I have about 12 units. Most of them here in San Diego, but I also have a few in Tulsa, Oklahoma as well. So I have a little bit of out of state experience too.
So tell us that's interesting. Tell us about Tulsa, Oklahoma.
Yeah, Tulsa is it's cool. I call Tulsa the value stock of real estate investing, primarily because it's just a very safe bet. During the pandemic, when most properties were climbing in value like quite substantially, Tulsa just stayed pretty even. And even times when the market goes in a downturn, Tulsa stays pretty even as well. So it's a very safe play, better for buy and hold than short term investing or short term renting. And I love it. It's where my wife is from too, so it's a good excuse to go out and visit family.
Nice, nice. So then, if the property values don't go up that high, then
Mhm.
then the rate of return must be pretty good.
Yeah, the whole thinking with investing in Tulsa and just the Midwest in general is you don't get as much appreciation as you do in California, but the cash flow is much better, and it's considered more landlord friendly. You're able to raise rents a little bit easier. You're able to get tenants out who aren't behaving properly, I think is a good way to put it. And it's just, yeah, it's more of a cash flow monthly income play than it is appreciation.
Okay. Um, and for our viewers, typically you either have high appreciation or you have better cash flow. The two and two don't tango together.
Yeah, not always, I would say. Although here in San Diego, we are fortunate that our rents are pretty high, and I was lucky enough to buy some properties when rates were a little bit lower. So you do get a little bit of cash flow, but the real play is appreciation, and then all the tax benefits and all that you get with real estate investing.
Right, right. Okay. So what we wanted to do was to analyze two different properties just to show our viewers, um, what would be the difference between two. So let's look at property number one,
Let's
right?
do it.
And so let me see if I can add this to the screen. So property number one is at 8672 Via La Jolla Drive, number two. And this place is a one bedroom, one bath, 16 square feet, so a little over 1,000 square feet. And it's a pretty nice property. So there is the living
Yeah.
room that has high ceilings and pretty nice space to go with it. And the bedrooms are sort of the loft style. This is a nice size patio attached to it.
Oh
Um,
yeah.
and I guess you could put a wall here and close this off into a proper bedroom, or if you don't like that and then you enjoy it just like this, it's a pretty nice space
Yeah.
um, with a nice sized bathroom, walk-in closet, um, and then you have beautiful grounds within the complex in a with tennis courts and And this is in the heart of UTC, so great area. So this one is listed at 783, and homeowners fees for is 575,000. Okay, so this is property number one. Property number two is 920 Streamview Drive, and this one has 4 units. Each one is two bedrooms, one bath, 950 square feet. And so this property we don't have rental information for, because it's mostly uh, uh, owner occupied probably. And then property number two, this one, let's look at some of the pictures. Not very many pictures, and not very attractive pictures either, but you know, hey, you've got 4 garages. That's always
There you
good.
go. 480 is.
So, okay, so that's that. And then there is a sample of one of the kitchens, which is actually not that bad. It's, white kitchen, which is up to date and
Yep.
looks nice and clean. There's the aerial view, and it has a canyon behind it. So, it's somewhat nice. And there's the larger aerial view, and that's all the information we have on this property, besides the fact that it says it's a high producing income. It says 1 unit is remodeled, 2 others have new floors, new fence, and trees recently removed, which probably they're saying that because they mean to say that the sewer line is not going to have issues. uh,
Right.
so, let me ask you this: what do you think? Which one do you say is a better place to invest in?
Yeah, that's a good question. I think it's really going to depend on what the investor is looking for. I'll just start with the first one. I really love La Jolla. I think it's an extremely desirable destination. It's where a lot of people want to live, and they're willing to pay like a substantial rent to live there.
Right.
Um, and also too, the thing with that one is it's very very luxurious looking. It's got a lot of amenities, a lot of things to offer a tenant that you typically wouldn't see with like a single family home or this other property.
Mhm.
So we'll put that on one side. On the second side, with the multifamily property, the thing I like about multifamily that differs from single family or even condos is if you have vacant units, you're still going to be collecting some income unless like all 4 units are empty. So let's just say a tenant moves out of one property, 3 of them are still occupied. You're still going to be collecting 3 rents while you're kind of getting that fourth unit updated. There's always some turnover involved with renting out real estate.
Mhm.
So if you really do need the income every month, then I would say the better investment would be the multifamily.
Mhm.
Um, if you don't mind the turnover, or you have a tenant that takes good care of the property, and you're maybe looking for a little bit more appreciation and just sort of a better like looking property, then I would say the La Jolla one is probably better for you. Again, it kind of goes back to that cash flow versus appreciation, and yeah, it's a tough call to say which is better, but I think both properties would be excellent investments.
So I'm gonna then share my screen again, and let's see if we can look at this again. So assuming that our loan is a conventional loan, right? And
Yep.
so the first scenario was 783 purchase price, and let's say down payment is, let's say 25% down payment rate, interest rate 6.25%. Is that good?
Yeah, I would say that's decent right now.
Okay, and the HOA fee was
575.
575. So 575. Okay, and let's see what we get in terms of costs. Okay, and so cost. So you're putting down You're putting down $195,000. So altogether, along with closing costs, you need to come up with 214,000, and your monthly income, monthly expenses are going to be at 5235. Yes.
Yep.
Okay. Let's go down to rental meter. Just to see how much rental meter is going to tell us that this property will cost. So 8672 via La Jolla, and we're going to select the 1 bedroom, 1.5 bath, and let's see if we can say um, how much rental meter says we can charge for rent. So somewhere, so it's basically saying somewhere between $2,600 to $3,400 for rent. So safe to say we're collecting $3,000.
Yeah, I would say it's safe to say. The nice thing about that one that I just kind of noticed right off the bat is that it is very good looking. They renovated it very nicely, so you may be able to get a little bit more, but it's probably a safe bet.
Okay, so there's the property. There's our good-looking property, right? Okay, and we're going to be short by about $2,200.
Right.
Yes.
Yeah.
Okay, all right. So now let's move on to the other one, and the other one is 1.2 million. We're going to put 25%, and interest rate is going to be the same, 6.5%. No HOA fees here. And let's see, this property is going to be, it's going to cost us about 7,100, but the down payment at 25% is $326,000.
Right.
Before we were at, you know what? Might probably have to see if I can pull up another session so that we can compare these numbers together. What do you think? So, all right. So let's put that price back 783, right? And okay, I'm on the seller side. I want to be on the buyer side of this. Okay. Oh, you know what? It's not going to let me. It remembers me that I'm over here.
Yeah.
Let's see if we can 783 little. Let's see if it will let me pull up a different session. Compute. Okay.
95.
So 4660. Oh, I forgot the 575. 575 HOA fee. Compute again. Okay, 5235 here, and all right. So here I am putting down 326,000
Yep.
versus 214,000 here. I have a payment of, I'm short by $2,200 here, and here I'm collecting. I'm my cost is 7141. Now let's see how much my actual cost is. So if I'm going over here, so I am collecting 1450 plus 1425 plus 1425 plus 1485. So 5785 is what I'm collecting per month. And let's see how much was down. So monthly payment is 7141. This is 5785. So 7141 minus 5785. Oh, look, this one is only losing $1,356 versus $2,200 over here.
There you go.
How would you say that I can even it out so that I can make some more money?
Yeah. So this is kind of the thing we're seeing now, the higher interest rates. So in this example, the loan to value, which is how much equity versus loan you have on the property, is the loan to value is 25/75. So you're putting 25% down, 75% of it is being funded with a loan. So we're actually seeing an instance where people are actually having to put more down in order to at least break even or maybe even cash flow a little bit. So I'm not exactly sure how the numbers would pencil out, but you may need to put 35% down or 45% down or 50% down. What I haven't seen a lot of people do recently is maybe they sell a property and they have a lot of cash on them. They maybe buy like all cash and then they're just sort of sitting on it and waiting to see if seeing if they could maybe refi in a year or two when rates are a little bit better. So now we have 45% down. It seems to, I can't remember what our rent total was for that one, but I would assume that we're probably kind of breaking even on that. What was that?
57.85 is the amount of rent we were
Yeah.
collecting.
So on this one, we're gonna have to put 45% down versus 25% down, and we're breaking even on this one.
And then on this one, if we were to put 45% down, let's see what it would look like if it would cash flow if we put 45% down. So, oh, look at this. It still wouldn't cash flow at 45% down.
Yeah. No, not at the rents we were looking at.
But here's another thing. If I'm looking at this, and if we go back to the properties, so if you're at this property, 3,000, you said $3,000, right, per month?
Yeah, that's a safe estimate.
But I would say you can't really maximize more than 3,000 a month for this property, right?
Right. It's in very good condition. There really isn't much that you could do to go above what the market's sort of commanding, so to speak.
Right. But look at over here with this one, you're at 2 bedroom, 1 bath, 1450 actual rent, but the projected rent is almost at $2,000 if you were to increase rent. Now, we all
Yeah.
understand that you can't increase rent by that much overnight, but as the tenants move out and you can fix up the unit and then re-rent it, you have a huge potential to raise rents and maximize income, right?
Absolutely. Yeah, no, that was the first thing that jumped out to me is that 1,400 for a 2 bed, 1 bath is pretty low, to be honest. And that is something too you can work out during escrow. You might be able to negotiate the tenants to vacate the property before closing, or you just sort of raise rent over time, or maybe they move once you purchase the property, and then you can fix it up and charge more rent.
So in other words, if you lock yourself in with $5,600 as your base expense, and then over time you're able to raise the rent, then you get yourself to positive cash flow and you can make some money.
Yeah, and I think if I'm not mistaken, in our previous example where we did 25% down on this one, had each unit been rented at the market rents, I think we would have been breaking even, if not cash flowing a little bit, at right around 8,000 for all four.
Right.
So in that instance, you could put 25% down and probably break even, if not cash flow a little bit.
Right. There you go. Yeah. Yes. The only issue with that is you can't do it right away because unless you basically tell during escrow, you negotiate to pay the tenants off, get them out, get the place emptied out, and then you are able to raise rents right away and make some money there.
Yeah,
Right.
definitely, definitely.
So is this the type of stuff that you is this the type of conversation that you have with your buy and hold investors when you are working with investors?
Oh yeah, absolutely. Any sort of investor would have a conversation like this. I'm happy to analyze any sort of real estate deal, much like we've done right here. As you can see, it just takes a matter of minutes, and you're quickly able to decipher which investment is a better option. After running the numbers, we were able to figure out that this multifamily property was clearly the better option, and it only took us about 10 minutes to do. So it's a really quick conversation, and it's a very important conversation that helps you sort of navigate not just like the future earnings, but sort of what you can earn right off the bat and how much capital you have to bring to the deal.
There you go. There you go. Excellent. Okay, so in terms of working with investors, do you have any other tips or tricks that you like to share?
Yeah, for sure. I would say whether you're gonna if your plan is to buy an investment property, you should just be analyzing deals now. I mean, an agent such as myself could definitely help you with running up the numbers, setting up your own equations, and even if the plan is to buy an investment property 6 months from now, you should be like getting into the market, having those conversations with your agent because when it's finally time, you're going to want to be like a market expert of your own. That just comes with analyzing deals on a daily basis, what I like to call doing the work. And it's just, figuring out what you can rent certain properties for. For instance, that agent who listed the multifamily knew that the rents that they were getting were below market. He
Mhm.
was able to do his research and figure out, okay, these could actually rent for like $600 more than they're renting for now. Um, so I would just say do your homework. Always be checking the market, always staying up to date with the numbers. And a good investor real estate agent like myself could definitely help you with that.
Excellent, excellent. All right. Well, thank you very much, Andy, for your wisdom and for your expertise. We really appreciate it.
Yeah,
And audience, if you are thinking of contacting Andy for any sort of real estate advice, you can catch him on his cell phone, which is right here, or you can email him at his email, or you can find him on Instagram, and he has a very, very popular Instagram page, and he does a great job representing those old homes because he's an expert in finding and recognizing and catching those beautiful older homes. And as always, we appreciate you being at our show. If you have any comments, we appreciate for you to write them down for us. Or if you like our video, please give us a thumbs up. And at Pemberley Realty, we are a boutique brokerage with amazing agents such as Andy. So if you are thinking of buying, selling, or investing, please reach out to me or to Andy. And we are here and always happy to help with your real estate projects. Have a great day. Thank you.
thank you.